American Advantage Law Group is proud to bring you this webinar for your legal
issues you must know when buying a practice by American Advantage Law Group, Inc. The process. Questions you need to ask yourself. Will you need to hire a lawyer, an accountant, or another professional? Have you already worked in the industry in which your business will operate in? Which kind of buyer are you? Business as a livelihood? Business as a strategic move? Business as an investment? If you are buying your business from someone, have you discussed matters such as payment terms, liabilities, buyer's warranty, and assets being transferred? Can you afford the initial cost when purchasing a business and the cost expense afterwards? About 90% of businesses fail because of an insufficient amount of capital. The process continues. If you have thoroughly evaluated a business and desire to go ahead with buying it, there are a couple of steps you'll have to take so that the purchase will go smooth. First, you and the owner will have to agree on a reasonable price. A sufficient manner of doing this is to hire an experienced appraiser. Second, you and the business owner will agree on which assets you'll buy and how you will make payment. More often than not, businesses are bought on an installment schedule with a sizable down payment. If everything is going well thus far, and you have outlined the terms on which the seller and yourself agree, you'll need to generate a written sales agreement. The process continues. When negotiating a price, look at sales of comparable businesses. Other than an appraisal, someone can view sale prices of other businesses that is similar to the one they are trying to purchase. It has become popular for someone to attend a service club conference to consult with others in order to ensure that they are not being ripped off. The process continues. Entity sale versus asset sale. Entity sale. The shareholder will sell you all of their stocks. Therefore, all assets the company has will be yours. This includes furniture, inventory, and even intellectual property. Asset sale. The shareholder will arrange for all or most assets to be sold onto you. You will be able to get depreciation benefits sooner if you buy a business as an asset sale opposed to an entity sale. In an asset sale, you are not usually responsible for the existing debts of the business. Also, if you are not buying a company that's already a corporation or LCC, you might want to consider making one so that you can have an entity to buy, run, and own the business. The process continues. Transferring assets documents. Insurance certificate for the policy covering company assets. Name changing certificate for assumed name. New signature cards for bank accounts. Name change document for utilities and tax bills. Mortgage or deed of trust. UCC financing statements. Financial Acquisition Statement, IRS Form 8594. Covenant Not to Compete Form. The process continues. Preparing the sales agreement. To prevent future arguments, you need to be specific in the sales agreement about what's being sold and what's not. Otherwise, you may get into a legal fight later over whether something very simple, such as a business trade name, belongs to you or the seller. Furthermore, you may find yourself acquiring accountability for things you desire to exclude. For example, potential lawsuits for toxic damage found after you've just bought a business. Another thing to look out for is the fact that the seller of the business that you're buying or the business itself may owe money to another person or business. If this is true, there is a chance that the creditor has established a lien on assets of the business. You will want to question the seller about this prior to purchasing the company or business. Lien: a security interest in property, either real property or equipment or other business property. The process continues. Preparing the sales agreement. If you are buying the seller's corporate or LLC entity opposed to the assets of the business, you normally will not have to stress about specifying in the sales agreement the assets being sold. By definition, everything the LLC or corporation owns that is not specifically excluded will be transferred as part of the sale. But often there are some corporate assets that you and the seller agree will not be included in the transaction. For instance, the corporation may own a camera with data on it that the seller would like to keep. If you buy the corporate stock, the camera will automatically be transferred as part of the sale. However, the seller may specifically ask that he takes the camera with him. The process continues. Preparing the promissory note and other documents. Usually, when a small business is transferred over to another party, the seller does not acquire the purchase amount in one lump sum. Some cash deals do occur, but not as often as installments. Cash deals occur especially where the buyer is a large corporation or can get third-party financing. If the full amount is not paid, the buyer gives the seller a promissory note for the balance he or she has yet to pay. The promissory note usually sets up a schedule of payments to be made over a period of time, such as 3 or 5 years, with the buyer also agreeing to pay interest on the unpaid balance. This process is referred to as installment sale. Make sure that there is an understood agreement about consequences if payments are not paid on time. Make sure that the agreement coincides with the state laws. More specifically, you should keep within the legal amount of interest the state says interest should be. You can look for the state's inquiry statute. It regulates the range of interest people should charge. The process continues. Ensure that the seller will not compete. The possibility that the seller may start a competing business or go to work for another business that is in competition with the one you are buying is not an uncommon move. To prevent this, you will want to make a deal to cut off the seller's ability to compete with you in the same field. The best way to deal with the issue of competition is to ask the seller to sign a covenant not to compete that covers a period of years after the sale. Depending on the type of business you're buying, the covenant might limit the seller's competitive